There's a lot of people running around like, oh, look at the bubble and valuations, all these other type of things. And there's some drivers to those valuations that are keeping those valuations elevated that we've seen over really since 2008. Valuations have been high and they continue to be elevated. And when you even do have corrections, you immediately get a bailout from the Fed. 2020, 2022, the Fed stepping in some form to bail out Silicon Valley Bank crisis or COVID. And so you just kind of keep the game going. And now you've sucked in all the retail investors to basically buy every dip. I posted a chart on Twitter this morning showing that now even professional managers have now gotten into the buy the dip game. Retail investors have been doing it since 2020, and now professional investors are stepping in, buying the dips as they come along, because you've got to perform with the markets. If you don't perform with the markets, you're out of a job. So you start doing what the markets are doing, and so you start buying every dip. And again, there doesn't seem to be any risk. This is the moral hazard that we've spoken about before. The Fed has provided this insurance against downturns, which now people go, well, there's no risk. I just buy stuff and it goes up. And if something does go down, that's okay. The Fed's going to bail us out. But the question is what happens? Why would the Fed not bail people out now at this point?
This is where the Fed's dual mandate comes in, right? It's employment and inflation. Just focus on employment. If they let this thing burst, the unemployment rate's going to skyrocket. So they have kind of their economic duty to keep this bubble going. Part of the problem is they provide liquidity, but that liquidity is distributed by the financial sector. While the Fed can say, here's liquidity, we only want you to use it on treasuries and high-grade corporates and mortgages, financial sector will do whatever they want with it. So it's going 5 times leveraged ETFs to crypto, to gold on margin, to highly speculative stocks on margin, to private equity, to a bunch of speculative things, some of which have no real productive value. So that's where the kind of disconnect comes into the market. And will the financial markets learn their lesson again? Why should they? They know they have the Fed backstopping them. So it's not just buy the dip, it's we got Fed liquidity and the Fed will never really take away liquidity.
This was one of the arguments for a long time that in 2010, 11, 12, 13, 14, the markets are going up, the Fed's doing QE. A lot of people were saying it's like, oh, the QE doesn't impact the financial markets, but it does, because when the Fed provides liquidity to the banks, it's the hedge funds, it's the money market funds, it's people going to the repo window that's getting that leverage into the system. So this all directly relates ultimately to why asset prices keep going up, because all this liquidity is finding its way into the markets, not just dollar for dollar, but on leverage, because this is where the leverage is coming from.
Catch me daily on The Real Investment Show. The link is in the description.